Opendoor stock is making headlines again, but this time, it's not just for price movement. It's for what the company didn't do. This week, Opendoor officially regained compliance with Nasdaq listing standards by maintaining a share price above $1 for at least 10 consecutive trading days. That's big. But what's even more interesting is what happened next. The company cancelled its scheduled shareholder vote on a reverse stock split. Now, on the surface, that might seem like just another regulatory update. But I think there's something deeper going on here. I think this decision says a lot more about what Opendoor's board sees coming, and it might just be the strongest signal yet that this stock is preparing for something big. Let's break this down. For the past several months, Opendoor has been in a tough spot. The stock dipped below $1, raising red flags about possible delisting. That triggered a plan for a reverse stock split, something struggling companies often do to regain compliance. It's not ideal. A reverse split often dilutes shareholder value, weakens confidence, and feels like a desperate move to stay afloat. But this week, something changed. Opendoor crossed the 10-day compliance threshold. And instead of going ahead with a reverse split anyway, just to be safe, they pulled the plug entirely. Not delayed it. Not postponed it. Cancelled it. That kind of decision sends a very specific message. It says, we believe our stock will hold up on its own. We don't need to manipulate the price through a reverse split to meet listing standards. We think the market is about to reward us, organically. And that's not a message you send unless you have reason to believe something good is coming. Like, for example, earnings. Let's remember, Opendoor is scheduled to report earnings next week. The exact date hasn't been confirmed publicly yet, but all signs point to early in the week. That means the board made this decision with full knowledge of where the numbers are trending, and with enough conviction to say, we're good. We've got this. To me, that's incredibly bullish. Companies don't just guess when it comes to compliance. If they were still unsure about how the market would respond post-earnings, they'd likely go ahead with a reverse split just to buy time. But the fact that they cancelled it outright? That suggests they've already seen the early results, and they're feeling confident. Now let's add some context. The stock closed at $2.10 on Friday, up more than 14% for the day. That's not a fluke. That's not just meme stock noise. That's the market starting to catch on. The move held up after hours too, showing no signs of profit-taking or reversal. Retail sentiment is building. Opendoor is one of the most talked-about names on Reddit and StockTwits again, ranking alongside Reddit stock itself as a top trending ticker. Meme stock playbooks are returning, and this time, Opendoor might actually have the fundamentals to back it up. Now, here's where things get interesting. Opendoor still has very high short interest. Estimates place it well above 20% of the float. And a lot of those shorts were added when the stock was trading in the $1.30 to $1.70 range. In other words, they're underwater right now. If next week's earnings surprise to the upside, even modestly, those shorts are in trouble. We could see forced covering, panic buying, and retail jumping in simultaneously. That's how short squeezes happen. And the groundwork is already there. Let's talk about what to look for in earnings. No one is expecting Opendoor to suddenly report massive profitability. But what investors will be looking for is progress. Are losses narrowing? Is adjusted EBITDA turning positive? Are transaction volumes stabilizing? Are margins improving? Even incremental improvements across those categories could serve as a trigger. And based on the board's recent confidence move, it seems like they're expecting some of those boxes to be checked. Now, keep in mind, Opendoor has already undergone major restructuring over the past year. They've cut costs, scaled down in certain markets, and shifted focus toward profitability. So this isn't just a speculative turnaround. This is a company that's been making the hard changes, and might finally be ready to show the results. If that happens, we could see a sharp re-rating of the stock. Let's play out two scenarios. In scenario A, Opendoor reports slightly better than expected earnings. Losses shrink, guidance looks steady, and there's a hint of EBITDA positivity. That's enough to trigger a continued rally. The stock could move to the $2.50 to $3 range very quickly, especially if volume spikes and shorts begin to cover. In scenario B, the company exceeds expectations more significantly. Maybe they show stronger than expected housing demand, or better tech-driven efficiencies in their transaction model. That's the kind of report that could launch Opendoor beyond $4 and make people reassess the long-term thesis entirely. Now, obviously, there's also scenario C, the downside. If earnings disappoint or the outlook is weak, the stock could pull back. But here's the thing, the risk-reward heading into next week feels very skewed in favor of bulls. The company already took a proactive step by cancelling the reverse split. That's a huge tell. The market has started to price in optimism, and retail traders are already circling. This might be one of the cleanest setups we've seen for Opendoor in over a year. And while it might look like just another meme move on the surface, it's actually a combination of fundamentals, sentiment, and timing all working together. So what should we be watching for? First, Monday's pre-market volume. If we see strength early, that could indicate traders are getting positioned ahead of earnings. Second, options activity. If we see spikes in short-dated calls, that's a sign that bullish bets are increasing and could pressure market makers to buy stock in response. Third, social sentiment. If Opendoor remains a trending ticker heading into earnings day, and the buzz stays positive, that could accelerate momentum quickly. And finally, of course, earnings themselves. That will be the ultimate catalyst, one way or the other. But make no mistake, the board's decision this week wasn't just about compliance. It was a message. A subtle but confident message that they like what they're seeing internally. And that's the kind of clue traders should never ignore. So here's the bottom line. Opendoor just avoided delisting. They cancelled a reverse split. Retail momentum is rising. Short interest remains high. And earnings are right around the corner. This setup is rare. It's clean. It's charged. And if the numbers back it up, Opendoor could be about to make its biggest move yet. Let me know what you think in the comments. Are you buying ahead of earnings? Waiting for confirmation? Or still sitting on the sidelines? Whatever your view, this next week could be one to remember. Thanks for watching. Don't forget to like, subscribe, and hit the bell if you want more deep dive analysis like this.